Before you ever use a credit card, there are a few essential rules you need to know. Understanding the system could be the difference between building wealth and sinking into debt. Hi, I'm Angie, your personal finance expert, and I'm going to walk you through how credit cards really work before they work against you. Lesson number 1, applying for a credit card. When you get a credit card, think of it like a job application, but instead of looking at your work experience, the bank and credit card issuer will look at things such as your credit score, your income, your existing debts, and your employment status. If you are approved, you will likely receive a physical credit card. The card will come with a credit limit. Your credit limit is the maximum amount of money you can borrow at any time when you're using your credit card. Lesson number 2, credit limit and credit utilization. When I got my first credit card as a student during university, my credit limit was $1,000. This meant that I could only spend $1,000 on the card in one go, and if I wanted to spend more money after that, I would need to pay off the balance before swiping my card again for other things. One thing I have noticed that traditional banks don't really educate customers on when they get their first credit card is this whole concept of a monthly credit card cycle. So let me draw it out for you. Over here, we have the normal credit card statement timeline. Say you open your credit card on the 1st of the month. That's the start of your billing cycle. Over the next 30 days, every purchase you make gets tracked in that cycle. Then on the 30th of the month, your statement closes. That date, the statement close date, is when your credit card company finalizes your spending for that cycle. No more transactions, payments, or fees from that month can be added to your statement after this point. Let's say by your statement close date, you've spent $250. That $250 becomes your statement balance, and it's the amount reported to the credit bureaus to calculate your credit utilization rate, which is just a fancy way of saying how much of your available credit you're using. On your statement, you'll also see a payment due date. That's when this $250 need to be paid back to the bank or credit card company. The time between your statement close date and your payment due date is called your grace period, usually about 21 days. During that grace period, the bank gives you a window to pay off your full balance without paying any interest. So if you pay your $250 in full before the due date, you're borrowing the bank's money for free. Lesson number 3, credit score. It is good to note that if you want to keep your credit score high, you shouldn't spend more than 30% of your credit limit in one go. Let's say your credit limit is $1,000. By your statement close date, you've spent $250. That means you've used 25% of your available credit. That 25% becomes your credit utilization rate, and that number matters when it comes to calculating your credit score. Most experts recommend keeping your credit utilization rate under 30% because once you go above that, it can signal to lenders that you might be over-relying on credit, which may cause your credit score to drop. The higher your credit score, the more money banks may be willing to lend you when you want to borrow a larger amount of money to make a big purchase such as a house or a car. It's no problem if you need to spend more than 30% of your credit limit in a month. You can just pay slightly earlier before the statement close date to reduce your reported credit utilization rate. Keeping your credit utilization rate as low as possible is a good signal to your bank or credit card company that you are a low-risk lender who knows how to manage your money. At this point, you're well aware that credit cards are not free money. When you use a credit card, you are using the bank's money and not your own. So now in lesson number 4, I'm going to teach you how to use your credit card to build up your credit score. There are just 3 simple steps. Number 1, stay under that 30% credit utilization rate as much as you can. Number 2, treat your credit card like a tool, not free money. Use it for small, regular purchases, stuff you were gonna buy anyway. Going for your weekly grocery shop to restock your fridge, getting gas for your car, or paying for small bills such as your gym membership. Charge those amounts to your credit card. Number 3, make sure the amounts that are charged to your credit card you can pay off right away and in full by the statement due date to avoid paying any interest. Interest is a fee you pay for borrowing the bank's money with your credit card, and you will only be charged this fee if you don't pay off your credit card balance on time every month and in full. Okay, after you've used your credit card to buy the things you needed to buy, what's next? That brings me to lesson number 5, paying off your credit card. When it comes to paying off your credit card, you have 3 options. 1, making the minimum payment. 2, partially paying off some of the balance. Or 3, paying off the full credit card statement balance. When you make the minimum payment, most of it goes towards interest and not your principal balance. So even though you are paying every month, your total barely goes down. So whatever balance you don't pay off gets charged interest again next month, meaning you're now paying interest on interest. That's how $1,000 of debt quietly turns into $1,200, then $1,500 over time. When you make just a partial payment, aka paying slightly more than the minimum but not paying enough to pay off your credit card balance in full, you will pay off the balance much faster than if you were just paying the minimum balance. But the same downsides are still there. You're still getting charged interest for the unpaid balance that constantly gets carried forward month over month, and your balance may keep growing. However, when you pay your balance in full by the statement due date, you don't owe the bank a single dollar of interest. How great is that? That's because you're using your grace period, the window usually 21 days after your statement closes, where the bank lets you pay off your purchases without charging any interest. It's basically like using the bank's money for free for up to 3 weeks every month before you have to pay it back. You get all the perks, cashback, points, protection, without ever paying an extra cent. I think that's pretty worth it. So next time someone tells you credit cards are bad, you can tell them only if you don't know how to use them properly.